Earnings off to a decent start this quarter. Banks garnering a positive reception. Tech high-flying names like Tesla and Netflix viewed a bit more cautiously by investors. This coming ahead of next week's major rush of results. Joining us now to discuss is Ahmed Riesgo, Chief Investment Officer at Insigneo. Ahmed, thanks so much for stopping by today. Let's just start with earnings and kind of what we've seen so far and really what you've seen so far from the names that have reported. Are there any kind of thematic takeaways that you're starting to build kind of into your thought as we get through the next couple of busy weeks for corporates here?
Look, I would say so far we're quite early, although, like you mentioned, next week is one of the biggest weeks in the earnings season, so that should give us a lot more information. If I had to sort of put a rating, I would say it's been okay. I would say, though, there have been some troubling signs. And some of the troubling signs that we're seeing are not so much for right now, but for down the line, for the second half of the year. And what we're seeing is that in some instances with some companies, you saw it with Ford, with Electrolux, even with Volvo, we're starting to see that disinflationary pressures, which are being welcomed on the macro level, are actually going to probably start being a headwind for earnings going into the second half of the year. So that's actually what we're focused on right now.
I mean, how big of a headwind? What are we talking for in terms of what we could expect here over the coming quarters?
Look, we expect inflation to continue to trend down. It's in a clear disinflationary trend if you look at, across various matrices. And like I said, that's good for the macro environment, that's good for the Fed, and that's good for the U.S. economy. But for companies, we think that's going to definitely be a headwind in the second half of the year. Now, we don't think it's going to be a strong headwind to the point where you're going to see the market really sort of take a nosedive here into the second half of the year. But we do expect weakness. So we think the market, the S&P 500 specifically, will end the year slightly lower than where it is today.
And, Ahmed, thinking about kind of the market over the balance of the year, I was just looking at the note you sent over, and kind of high up, you highlight that that consensus view headed into 2023 is that stocks were going to fall. And we have seen Wall Street kind of, try to, let's say, back into a more acceptable outlook for the market. But I guess just in thinking about, the pack dynamics maybe for strategists, what's been your takeaway from, the market once again, kind of the old cliche, inflicting the most pain on the most possible people with kind of what we've seen this year?
Yeah, I think what you're seeing now is strategists are also sort of trying to catch their tail. Just when you see them starting to turn more bullish is when we think we should actually perhaps start taking some risk off the table. Although we think it's perhaps a little bit too early to take risk off the table. Technically, this rally looks very sound, and it looks like it could extend for quite some time. But going into the second half of the year, like I mentioned, we do expect weakness. Now, remember, this was the first year in the history of the Bloomberg data series that Wall Street, as a consensus, expected the S&P to go down. And obviously that has not happened, and we don't expect the S&P to end the year on a negative trend. But like you mentioned, this sort of highlights the perils of when you get into groupthink. And when everyone starts sort of singing the same tune, that's a very good opportunity to go contrarian.
Now, we spent a lot of time today talking about the equity market, but I want to ask a little bit about private markets, what you're seeing there. And I guess as you think about, building a portfolio, what looks more interesting to you today than equities? And because that's a large world out there of alts, whatever you want to call it. What are the things in that space that are most interesting to you guys today?
Yeah, so first let me start by saying that we definitely think that for sophisticated investors who don't have the liquidity needs, private investments are going to be a crucial part of their portfolios going forward, precisely because we don't expect public market returns to be as good as they have been over the last 10, 20 years. That being said, they're not a panacea either. They obviously have risks. The mark-to-market doesn't happen as often, so many times investors are sort of saved from themselves from making emotional decisions. But there could be extremes, and what we're seeing right now is that private credit looks a lot more attractive to us than private equity. Both spaces have seen a lot of money go in. There's actually a concerted effort in the private investment world to expand the investor base to go beyond pensions and institutions and start including more retail clients. So that's going to definitely pressure returns in the space generally. But drilling down, private equity looks a lot less attractive to us. The macro environment is less attractive for it, and the valuations are still quite high. So we would suggest that investors who are going into the private investment space right now to allocate more money to private equity than they otherwise would.
Ahmed,
to private credit.
Ahmed, how does the Fed's upcoming meeting here, just in terms of your expectations for a recession, the fact that it doesn't sound like, at least from your perspective, that we're out of the woods quite yet, given that portfolio allocation that you think is attractive at this point, how do you think the Fed's narrative maybe potentially reshapes the market's momentum here going forward?
I don't think the Fed's going to surprise the markets at this point. If you look at Fed funds futures, they're basically pricing in over 90% chance that the Fed raises rates by 25 basis points next week. I think they're going to do that. I think if they did not want to do that, they would have a signal to the market beforehand, and that has not happened. So we fully expect that rate cut, even though we don't think they should, by the way, but that's another story. The signaling is going to be important as far as, because what the market wants to hear, given the rally that it's had, is that the Fed is done pretty much, and that this is the last rate hike of this cycle, and they need to sort of telegraph that in any way. If they don't, or if they signal something to the contrary, that perhaps the other meeting will also be a live meeting, so to speak, you could definitely see some pullback here, given the strength of the recent rally.
Well, so let's double click then, Ahmed, on that notion that the Fed, in your view, should be done here. Is that just based on what we've seen in those headline inflation numbers coming down, or is it more about, the financial stability risks perhaps that were surfaced, back in the bank crisis in the spring?
It's a combination of both. Look, the Fed constantly makes policy mistakes. It's actually irrational belief to think that they're committing one now. Historically, they do. So if you bet that way, you're going to be more often right than you're wrong. So the Fed clearly waited too long to begin this hiking cycle. What that's likely going to mean is that they're going to probably overextend themselves and perhaps overtime here. I think if they would have probably paused one or two meetings ago, the chance that we could actually have a soft landing would be materially higher. Part of the reason why we are, although we're in the short term not projecting a U.S. recession, part of the reason why we think a U.S. recession will begin sometime in the middle of next year is precisely because of how tight monetary policy has gotten.
Yeah, certainly. Ahmed, we are both old enough to remember when 2.5% was seen as the terminal rate, and here we are approaching 5.5% on the upper bound. Ahmed Riesgo, Chief Investment Officer at Insigneo, thanks so much for your time. Have a great weekend.